Good evening, everyone. Time for another silver update. We are now approaching the bottom line of this flag formation, pennant formation. It's sort of a descending one. It's kind of halfway between. Now these formations, I drew some other ones in here. You can see there was a little mini one here, and it actually resolved to the upside. There was a second one here that broke out to the upside but failed, and now we seem to be testing the lower part of this flag. So you can't say definitively that it's going to go one way or another, and I'm going to talk a little bit about investment advice, investing in silver, etc. But you can't say definitively one way or another which way it's going to go based on a breakout of one of these flags. You can just say that it indicates that it will go that direction. As you can see on this breakout here of this spot right here on the pennant, it wasn't a particularly unique support or resistance area, because you had prices back in here above it and prices down below it here. So it wasn't really unique in that sense, but it was unique in the sense that it was a break above this descending trend line. So these trend lines are valid. They do have predictive value, but once you've broken out of this, it doesn't tell you how much farther you're going to go. Now you can see we actually came back down and just got inside of that flag after we had broken out of it. So it's kind of a short-term indicator. It doesn't tell you everything. It just gives you an idea. There's another one right here. You can see that it kind of broke out of it, and it broke out to the upside, then came down, and then it went up. So they're not any kind of surefire predictor. Of course, no such thing exists in the markets. If it did exist in the market, then obviously people would catch on to it, and a lot of people would start using it, and by the very fact that a lot of people would be using it, it would no longer be a surefire predictor. And we've actually seen that with a lot of the technical tools that are out there in the market. You can see the list is very large, whether it be the accumulation distribution, the Bollinger Bands. You've got a lot of these I've never even heard of. You've got the Elliott Wave Oscillator. You've got the MACD, which I like to use. You've got stochastics. You've got on balance volume, etc. So you've got a lot of these Williams relative, which is another one that a lot of people like. So you got a lot of these indicators. They all have some amount of predictive value. To a certain extent, their predictive value is based upon the level of number of people that are watching them. And that can be a very tricky situation. Same thing with support and resistance. If you've got a lot of people watching a support and resistance line, that can cause great fake outs, or it can also cause great rallies. It just depends on how people react based upon that. So all of these things are fluid. They're by no means perfect predictors. And so using that, I wanted to segue into some statements I want to make about investment advice. A lot of people have been PMing me and emailing me and commenting lately about my quote-unquote investment advice. First of all, I want to make it clear I don't give investment advice. These videos are just to tell you what I'm doing. I'm not recommending that you make any particular investment. I'm not allowed to do that because I'm not an investment advisor. So I'm simply telling you what I'm doing and some ideas that I have, and if you get anything from that, that's up to you. Now, on the topic of the numismatic coins, I need to clarify some things because apparently it wasn't clear. The numismatic coins that I pointed out in my last video, top 5, those coins at the top, the Tiger and the 2007 Koala, for example, those are coins that I purchased in the past that I considered at the time I purchased them to be numismatic plays, which they turned out to be. Now there have been some that I purchased that didn't turn out to be. I bought some of the 2008, 2010 Olympic Royal Canadian Mint maples, and I thought just by the design on those and the fact that it was a unique one-year sort of thing. I didn't like the hockey player coin. I actually liked the maple leaf wreath coin. So I bought those. Those never really panned out to be any kind of numismatic value. So it's always just a guess. But if you're going to be buying them for numismatic value, I'm not recommending that you buy them with some monster $20 or $30 premium on them. I'm recommending that you try to predict which of the coins are going to have a numismatic play in the future, and therefore you might have an added bonus. So for example, if you're looking at $35 an ounce Silver Eagle and a $36 an ounce Fiji Taku, and you believe that the Taku is a very unique coin and possibly low mintage coin and a coin that might have a lot of numismatic demand in the future, then it might be in your interest to pay that extra buck of above spot to pick up that coin instead of the Eagle. That's the only thing I'm pointing out. I'm certainly not recommending that anybody buy anything, but I'm not recommending specifically that anybody buy these coins that have these large inflated premiums. That seems to be the misunderstanding. I am just trying to educate you as to how you might be able to predict a future premium increase, and therefore that in the end is going to encourage you in your stacking. Of course, the goal of all of this is to encourage you in your stacking as far as just stacking physical silver. And that's not investment advice. That's just what I would like people to do, is stack physical silver. Now, I ultimately believe that the price is going to go at some point above $1,000. That's not investment advice. That's just my opinion. But I am sharing with you my opinion as to some of the things that might have numismatic value in the future, and some, even more importantly, some of the characteristics that I'm looking for in particular mint coins by the particular mints, such as the primary ones, the Royal Canadian Mint, the US Mint, the Australian Mint, the New Zealand Mint, some of the European mints. Those are the primary government mints, and those are the coins that I really like. So hopefully that clarifies that. I'm not making investment recommendations, and I'm certainly not recommending that you buy some inflated premium on some coin. I'm just suggesting that you might want to educate yourself about coins which have the potential of having a future numismatic bonus that you might be able to get for just a couple bucks or a buck over spot compared to something else. So hopefully that makes that clear. Now let's segue over to the latest update from Clive Mond, and it just came out today. I wanted to read that to you because it's pretty on point as far as the political things. It's interesting that with this chart that I'm seeing here, the Clive's actually bullish. So let's jump into that. And he says, with Europe teetering on the verge of collapse, the world has been teetering on the verge of a deflationary implosion, and it still is. That is the reason for the recent severe downdraft in the markets. What is believed to be happening now is that the global banking elites, who are the de facto government in many countries like the US, are scrambling to prevent the collapse of their European division. The stakes are immense. If they succeed, they will kick the can down the road and push all or much of the bank's bad debts off onto the electorate and taxpayers via austerity measures, bailouts, and tax hikes, and the course will be set for a hyperinflationary depression. If they fail, then we will see the more immediately dramatic and much feared deflationary implosion. As we will see, smart money appears to be betting on the banks succeeding in their objectives. Why shouldn't they? As noted above, they are the de facto world government, and thus their will should prevail. If Germany and Mrs. Merkel, fearing hyperinflation, try to stand in their way, force will be brought to bear. A few more failed bond auctions ought to do the trick. With regards to the bank's power, it is interesting to note that Goldman Sachs has more power in the U.S. than the entire U.S. electorate, until the latter become mobilized, that is. The sudden realization that the global banks are about to come riding to Europe's rescue is what caused the strong rally across world markets last week. And although the markets look set to take a breather, it looks likely that they will continue higher as the bailout process gains traction. Other aspects of this fundamental situation are equally applicable to silver, are discussed at some length in the parallel gold market update, and we will now turn to examining the latest silver charts. Superficially, silver looks pretty sick on the charts and weak compared to gold. However, the more closely you look at it, the more bullish the picture becomes. In the last update, we had identified a potential head and shoulders top in silver on its 18-month chart, which would and still could become operative if Europe founders and the deflationary scenario prevails. However, the events of last week are evidence that a rescue in its early stages, and that large-scale money creation is on the way in order to facilitate this. This being so, the potential head and shoulders top looks set to abort, and there are some important indications that smart money has positioned itself for this. Now he shows you the 3-year silver chart, and he's pointing out first of all that accumulation distribution is strong. It's making new highs. This is this top up here, and in the middle he shows that he'd identified the head and shoulders tops. These are the heads and these are the shoulders. So the key issue is going to be whether this is established and goes down or whether it breaks out to the upside. On the 3-year chart for silver, we can see the potential head and shoulders top, but we can also see that volume indicators are strong relative to price, particularly the accumulation distribution line, which rather incredibly has been making new highs just over the past week or two, which is strongly bullish indication. A breakout from the momentum downtrend shown by the MACD indicator will be a sign that the major new uptrend is getting started. And this is his MACD right here, just turning over. And he's got a double MACD trend line drawn here with a top and a bottom. So it's kind of a MACD trend channel that he's drawn. The position of the silver relative to its 200-day moving average gives us insight regarding its potential upside from here. It has gone from being way above its 200-day moving average in late April to being some way below the average now. So clearly there is room for a big move up from here. And he goes to the 6-month chart, and you can see he's got the accumulation distribution making new highs at the top, and there is the triangle that he's drawing, or pennant formation, and then he's got the support in here. So this is drawn before today's actions, which we're now testing down into here. Action late last week signals a drop to early next week, but this should be followed by an upside breakout. So he did predict that. And then at the bottom is the on-balance volume. On its 6-month chart, we can see that silver price is currently being contained within the boundaries of an irregular triangle pattern that parallels the more symmetrical one that is formed in gold during the same period. Contact with the upper triangle boundary and the falling 50-day moving average in November resulted in the price being forced lower again, and also resulted in a failed breakout attempt from the triangle on Thursday and Friday of last week. However, the triangle is now rapidly closing up, so a breakout must occur soon. And while the rather bearish action late last week does suggest a short-term minor reaction, a decisive upside breakout is expected to occur soon, even if it is preceded by a false downside break, which he may believe that today was the case. In addition to the positive volume indicators, especially the accumulation distribution line, another factor pointing to the probability of an upside breakout is the fact that the price and the 50-day moving average are now quite some way below the still rising 200-day moving average, which was not the case in early November when the price turned back down. Now he gives you a little chart here on the commitment of traders. And he says, with commercial short positions on large and small spec long positions, we've dropped back towards their recent extremely low levels over the past couple of weeks. The commitment of trader structure certainly looks highly favorable for a major uptrend to get underway soon. When these extremely low levels persist for weeks but the price doesn't advance, it is easy to get skeptical about their implications. We have ourselves. We should not allow ourselves to fall into this trap. By the standards of recent years, these readings are very bullish indeed. So you can see from these commitment of traders, I don't really follow those a lot, but they're very, very small here relative to history. So that's very bullish according to Clive. So Clive has got a short-term bearish call and then a long-term bullish call. Now I wanted to talk a little bit about these indicators and their predictive ability. The predictive ability, as I said before, the predictive ability of an indicator is going to be based on people's reactions to it once it becomes watched. It's sort of a Heisenberg uncertainty principle sort of thing. Once a large enough number of people are watching it, then the indicator becomes decayed in its predictive ability, because as people react to the indicator itself, then the indicator becomes less and less valid. So some of these indicators have value, some of them have no value. I personally believe that the MACD and the support and resistance lines and the trend channels and the trend lines are the most predictive indicators. They're the ones that, in my opinion, don't really change that much over the course of many years. So addressing that, I wanted to bring up really quickly another issue that comes up a lot in a lot of the complaints and comments and emails and PMs and all the things that I get about. One of the big questions that comes up is, why are you using technical analysis to analyze these markets when you openly admit and agree that these are rigged markets? Now, that's a very good question, and I don't think I've directly addressed that question. So I want to explain that here. Now, as you see in the chart here where Clive gives the commitment of traders, this is a key indicator, a fundamental indicator of demand, and it indicates how many people are interested in buying. Now, these prices are paper prices, there's no question about that, although these paper prices are arbitrage to the physical market. If they were not arbitraged by the physical market, I could not have followed the smackdown that occurred right here to 26 and told you when I was buying at 28 on that night, etc., and thought that that was going to be a bottom. If that was the case, then that wouldn't be possible. So yes, these prices are manipulated prices, but the mechanism of manipulation is this market. So even though they are manipulated, they are manipulating it through something you can see. Now, to give you an example of something that would be different than that, imagine if they just gave you a price quote of silver every day, but they didn't tell you what the volume was or what the price was the previous day. You had to track that yourself or something like that. You really didn't have any of this information. And let's say that it was something like how they talk about the Rothschilds used to set the gold spot back in Europe, and they just have a daily price quote, and the mythology is that they just ask the old man what the price is and he'd tell you what the price is. If that were the case, that prices were established simply by someone saying this is the price, then yes, all of this would be completely invalid. But that's not how these paper prices are being established. These paper prices are being established by real long and short contracts on the COMEX that are being traded, and therefore there are numbers, commitment of traders numbers and volume numbers specifically, that indicate what is actually happening in the market. So yes, I believe there's predictive value to these technical indicators. As more people follow them, it becomes less and less, but the key indicators of volume and price and support and resistance, those are valid as long as these are real contracts. Even though they're paper, they're real contracts for paper that are being traded. So that's my position on that. That's why I follow these charts. I do believe they're active. I do believe, or accurate. I do believe they have some predictive power, but that's not absolute. So hopefully that explains that issue and why I rely on these. Now I wanted to jump over to my blog real quick because I've been putting a lot of things on that. It's a lot easier to make a post to a blog. And by the way, you can reach my blog if you haven't seen on my channel. If you go to my channel and click the banner at the top which says click for my blog, it'll take you straight to my blog. There's a lot more information that I can present on a blog than I can on a video, just because of the processing time and the amount of work that's involved. You can see that I'm embedding things. I'm trying to embed things and work on that process. So if I don't like to go through the process of downloading and dealing with Patriot Radio NewsHour and all those shows that I like to listen to. So I'm in the process of embedding the videos and audios and all the things that I like to use myself to keep up on the news, as well as my links that I try to use to keep on top of things, and then the latest articles that I feel are relevant to the silver community and the ongoing collapse that's happening around the world. So hopefully that'll be helpful to you. If you have any suggestions, go ahead and put them in the comments below. I welcome any criticisms or anything about how the readability or anything else is wrong with the blog, and I really appreciate the help on that. So looking at the chart, we are rounding down to the bottom side of this pennant formation, and we're waiting to see if we get a move to the downside, or as Clive expects, possibly a fake out to the upside. And of course, as I've said before, the time to stack is when the price is falling, and then the time to sit back is when the price is rising. The main thing is to keep on stacking, and we'll talk to you next time.